This module, we are going to move into the discussion of cash dividends, specifically a component of equity. We're going to talk about the declaration of the dividend, the payment of the dividend, and what journal entries relate to the dividends. So first of all, let's talk about why do we have a dividend? What purpose does it serve? Now, as an investor, when you invest in a share of stock, you're wanting to see a return on that investment. You don't just invest to donate money, you want to get money back. So there are a couple of different types of return you may see. The first one is your standard, what might be a long-term return. This is you holding on to the stock as the value rises over time. And then you'll sell it down the road. You buy it for $10 now. By the time you sell it, it might be a $70 share of stock. You've made $60 on that share. That's your long-term return. However, there are plenty of shares of stock that also issue dividends. This is a way of generating a revenue stream for an investor. Some investors are more concerned with investing in stock that just pays a dividend, so they get a little bit of money back right away instead of having to wait until later when they sell it. And of course, there's always the risk that if you wait until you sell it later on, the value may have actually dropped. You may lose money. So it all depends on what your goal is as an investor. So what does this mean for a company when they receive this net income? A company earns revenues, and if they have more revenues than they had expenses, they have net income. Now, they have a couple of choices on what to do with that net income. Theoretically, they could turn around and pay 100% of that net income right back to the investors in the form of a dividend. This would be a distributed earning. They also have the option to retain the earnings internally, and they can use that either as a safety margin. They could use that to expand or grow. They could use it for a variety of different things. So different companies handle this decision differently. But the point here is we could either distribute the earnings or retain the earnings. Dividends are a distribution of retained earnings. Now, you may be shocked. Now, this estimate is just there are several different percentages, several different studies out here. You may see different percentages, but 70% of companies do not pay dividends at all. Now, this is just a very round ballpark figure, but what that basically tells you is that a very large percentage of companies don't pay dividends. Instead, the only return to the investor is the increased stock value. Now, there are some very high-profile examples of companies that do not pay dividends. Google, Berkshire Hathaway, and if you're unfamiliar with that company, you may be familiar with the name of the founder, Warren Buffett. He's actually here in Omaha, where I happen to live, so I'm certainly a lot more familiar with that company than maybe some of the others. Amazon, eBay, Yahoo, Adobe. Now, I put Apple here in question marks. They are currently paying a dividend. Historically, there have been plenty of periods throughout their history where they have not paid a dividend, or they paid a very small dividend. Part of the reason, using them as an example, is they decided to use that money that they're generating to internally finance their growth. Research and development, again, developing new products to expand. So that's perhaps why they may have chosen to not pay a dividend. And as you can imagine, these companies are not hurting as far as the stock price goes. So just solely the fact that they don't pay a dividend doesn't mean it's a bad share of stock. It means that the growth is going to come long term by holding on to those shares. So why would a company not pay a dividend? I touched on this a bit ago. They may want to reinvest in the company. It tends to be cheaper than borrowing money. So if you pay out all of your dividends, all of your net income, if you pay it out in the form of a dividend, if you all of a sudden need money to expand, you then have to turn around and either issue more stock or go borrow money from the bank or bondholders. The interest that you have to pay for for the bonds or the loan may very well be more expensive than if you had just not paid a dividend. You just use your internal retained earnings to finance your growth. The other thing here As an investor, you have to keep in mind, it may be tempting to say, hey, give me the money. I want it now so I can see it. But what are you going to do with that money? You may turn around and invest it somewhere else. Let's say you can find a 5, 6, 7% bond, whatever. You get your dividend, and you can either go buy more shares, or let's just say you invest it in a 6% bond. So now you're earning 6% on that money that you received as a dividend. If the company had kept that money, they may be able to use it to generate even higher returns for you, although the return would be in the form of a long-term stock growth. Berkshire Hathaway, again, Warren Buffett's company, is a great example. They have to have a lot of cash on hand because Warren and the group, they're constantly looking for new opportunities, new investments, new companies to buy, and they need that cash to make an immediate decision. They can't wait to issue more shares of stock or issue new bonds to get money. The decision would be too late then. The opportunity would pass them by. So they do tend to sit on a very large sum of money solely for the purpose of grabbing these companies, acquiring them when the opportunity arises. So that's something to keep in mind there. Just as a reminder from earlier modules, dividends are not expenses, so they do not show up on the income statement at all. They have a similar normal balance. They're still a debit balance just like an expense, but the reason they're a debit balance is that they reduce equity. Equity has a credit balance. Dividends have a debit balance. So dividends reduce retained earnings, and therefore they reduce equity. So just keep in mind that dividends are not an expense. A very important concept. Here's how this would show up on the statement of retained earnings for a particular year. You'd start off with your beginning retained earnings balance. You'd add in any of your net income, and you would subtract your dividends when they are declared. Even if you haven't paid them yet, as soon as they're declared, they become a liability. They get moved out of retained earnings. Now, there's also the treasury stock reissuances that we talk about in a separate module. And then you get your ending retained earnings balance. For this module, the important thing to remember is that dividends reduce retained earnings. Now here we have some very important dates to be aware of for the dividends. For accounting purposes, we have 3 of them, but I'm also going to talk about a 4th one that's more important from an investor perspective. So first of all, we have the dividend declaration date. Now what I want to mention here is that regardless of what has happened in the past with a company, there is no guarantee that you will receive a dividend. If you invest money in the company as a creditor, if you lend money to the company, you are guaranteed your bond interest expense back. It's a contractual obligation. Now, if they break that guarantee, you possibly could push them into bankruptcy, sue them, take them to court. But again, with interest, there's a guarantee. With a dividend, there is not. Until the declaration date. As soon as the board of directors has decided that they are going to declare a dividend in that period, it then becomes a liability, no different than bond interest payable. Again, we're comparing the dividend to bond interest expense. The dividend only becomes a liability once it's declared. Now, that being said, even though I say there's no guarantee that you're going to receive a dividend, for those companies that tend to issue dividends on a regular basis, the main reason that investors invest in that stock is because they know they can come to reasonably expect a dividend to be paid. It's not a guarantee, but it's a reasonable expectation. The company and the board knows that if they don't pay a dividend when it's reasonably expected of them to do so, the investors could react. The stock could drop in value because, again, if most of its value was coming from the fact that it paid a steady dividend and all of a sudden it breaks that trend, the stock market is going to respond and the stock will become worth less. I don't mean worthless, but it'll be worth less money. The value will decline. The other thing in a more extreme situation that could happen is the investors, if they have enough power, if they own enough shares, if they get together with enough people that have shares of stock, they could decide to elect a new board of directors altogether that would have a more favorable dividend policy. So just a few things to consider there. But as far as the declaration date, on January 1st in this example, we would debit dividends for $100,000. And down below you'll see this is the example of $1 per share for 1,000 shares of common stock. So they would debit dividends right away, which reduces retained earnings for $100,000. But they're not paying it yet. They would credit credit dividends payable for $100,000. Now the date of record is another one. This tells the company who owns the stock on that date. Keep in mind that stock in the stock market is trading on a continuous basis. You know, you have different stock markets throughout the world, but in any case, it moves quite frequently. If you own a share of stock today, maybe you won't own it tomorrow. So to pay a dividend, you have to have one set date where you know who owns the stock. So this date of record is that date. You set this date up and you say whoever owns the shares today, they're going to get the payment, even though the payment may be a little bit down the road. A lot of times, at least for textbook examples, you'll see these dates a month apart. So for example, on January 1st, the board declares a dividend, and they say that whoever owns the stock on February 1st will get paid March 1st. So that might be the example. There's no journal entry needed for the date of record. It's just a tracking date. But on the date of payment, now keep in mind this has to come after the date of record, so by the day you pay it, you already know who is going to be issued the dividend. The payee was locked in on that date of record. Here we're going to be debiting dividends payable for the $100,000 to reduce this liability, and we're finally going to credit cash to pay it off. Now there's a fourth date here. This is not an accounting date, this is an investor date. It's called the Exdividend Date. So keep in mind, on that date of record, as soon as the board declares that dividend, it's now public. Everybody knows that, hey, if I buy a share of stock today, I'm also going to get a dividend in the very near future. I don't have to hold the stock for an entire year to get a dividend. If I own the stock on the date of record, I get the dividend. So let's say on the date of declaration, you buy a share of stock, and then the date of payment was 2 months later. You know that you're going to get a dividend just for holding the stock for 2 months. But here's what happens. As soon as that information becomes public, and sometimes even leading up to it, if there's anticipation that a certain amount of dividend will be paid, the stock will naturally increase in value. It will become in higher demand. So the stock on the stock market will increase in value to account for the fact that now there's a dividend that will be attached to it. But on the date of record, that value will drop, because if you buy the stock on the date of record, you no longer have that dividend attached. You'll have to wait until the next year to get a dividend. So what happens here, we have this date called the Exdividend Date, and this is generally in the United States 2 business days before the date of record. Now what that means is you have to buy this stock by the ex-dividend date, otherwise you're out of luck. If you don't buy it until after the ex-dividend date, even though it may be before the date of record, you're not going to get the dividend, and the reason being that in the United States, in the U.S. stock market, it takes 3 business days for the trade to settle, for everything to be recognized and recorded properly. So because of that, this ex-dividend date is really more important than even the record date as far as an investor perspective. Just a reminder, there are no guarantees for dividends, at least until it's been declared. Creditors will always get their money first, and that, again, the creditors will get their interest first. Now, in later modules, we talk about preferred dividends. One of the preferences there is that they'll get their dividend before common stockholders will get their dividend. But keep in mind, this is still after the creditors have received their interest. So the only guarantee that preferred stockholders have is that they'll get their money before the common shareholders. Now, the fact that this company offers preferred dividends puts the common stockholders in again, with a lower preference, they have less of a chance of getting dividends, or the dividend may be smaller. So keep in mind, the common shareholders have a lot of risk there. The preferred shareholders have less risk, but they tend to be locked in. Whatever that dividend percentage is, that tends to be all they'll get for a dividend. Whereas the common shareholders, the benefit, the reward for the risk is that if a company has a great year and has a big dividend, you may end up getting a very big dividend as a common shareholder. You may get nothing one year, you may get a big dividend the next year. So let's take a look at preferred dividends. Preferred dividends often are stated as either a dollar amount. Common stock, a lot of times you see a dividend recorded as a dollar amount. Preferred stock could either be a dollar amount or a percentage of the par value of that preferred stock. So let's take a look at this example. We have 250 shares of $100 par value, 8% preferred stock. So what that means is every share of stock is going to be paid 8% of the $100 par value, or they get $8 per share. So the dividend in this case that would be paid would be 250 shares multiplied by $100 multiplied by 0.08, which is 8%. That means that $2,000 in dividends would be paid out. Now, in this case, if the board decided to declare $3,000 of dividends in total, there would only be $1,000 left for the common shareholders. And that wraps up our discussion of cash dividends. We will have more discussion with the preferred dividends specifically and stock dividends in later modules.